to our class on the basics of the Elliott wave principle today. We're going to take a look at Elliott waves and how to use these to understand what price action or the market is trying to tell you, and also how to predict the future of the market. So it is only the technical analysis technique that can give you long-term perspective, which opposed to general misunderstandings of people that use technical analysis and that think it's only good for short-term trading. In the general consensus, technical analysis really is only for short-term trading or very short-term investing, because there's lots of factors that will affect the markets. But Elliott waves is one of the few tools that we have that will help predict a market movement for the longer term and help increase our forecasting ability. So before one can start to identify the types of patterns Elliott discovered and the rules that govern them, it's a good idea to first learn about labeling the wave degrees. Counting waves is a skill that comes with practice and proper application of the rules described. It is a good idea to start applying a wave count to a market you are familiar with and update it in time in practice. Now the fact is, I don't use Elliott waves. There's nothing wrong with them. It's just something I've never used, so I've never become an expert at it. I'm a chart pattern trader, and I'm a king of triangles. Okay? I'm the king of support and resistance, but Elliott waves is not something I ever mastered. So I know the general information, I know the background, the basics, which is what I'm going to share with you today. But my friends who use Elliott waves swear by them. They swear that they are extremely reliable, give you lots of information, and help make smart trading decisions. Now, Ralph Nelson Elliott developed the Elliott Wave Theory in the 1920s by discovering that stock markets, thought to behave in somewhat chaotic manner, in fact, traded in repetitive cycles. Now remember, up until the 1900s, well, first of all, there was virtually no trading anyway. And there was very little investing. Stock and corporations hadn't been around that long. And the markets moved a lot slower. And what came around in the early 1900s was Dow and Dow theory. It's the first time that we recognized that we could make some type of interpretation of price movements outside of using basically fundamental information. So Elliott discovered that these market cycles resulted from investors' reaction to outside influence, or predominant psychology of the masses at the time. He found that the upward-downward swings of the mass psychology, also showed up in the same repetitive patterns, which were then divided into patterns he termed as waves. Now, through science and observation, law enforcement has been able to look at, when a shooting happens, a mass shooting, exactly how the people move, how they react, and where the waves of people and what they do around the blast, the sound of the gunfire. And it's amazing that when you drop these over top of, they're horrible things, but mass shootings over mass shooting, whether it's a school shooting, whether it's an outside mall, whether it's a music venue, you can actually drop these patterns directly over the shooting event and the crowd and see exactly where the people are going to go. And they actually use it to set up triage stations. They use it to set up emergency release. They really understand how the crowds will move. You also get it in animal cycles. So we also get it in trading or financial cycles. Now, it wasn't until many, many, many years later that we applied this to online trading and the hectic market that we have now. Now, Elliott's theory is somewhat based on Dow theory in that stock prices move in waves. Because of the fractal nature of markets, however, Elliott was able to break down and analyze them in a much greater detail. Elliot made detailed stock market predictions based on unique characteristics he discovered in wave patterns. An impulse wave, which goes with the main trend, always shows 5 waves in its pattern. And on a smaller scale, within each of these impulse waves, 5 waves can again be found. So we actually finding major waves or primary waves and then finding waves within the waves. And in this smaller pattern, the same pattern repeats itself indefinitely. These ever smaller patterns are labeled as different wave degrees in the Elliott wave principle. Only much later were fractals recognized by scientists. Now, through the 1970s, or up to in the 1970s, Elliott wave started to become popular. It was published in books, it was talked about in newspapers. But remember, it wasn't until the 70s that we had any inkling of computers, internet, shared information. So this theory was actually used only by professionals, okay, and financial advisors. And some of them actually became known as Elliott Wave advisors. So the world, as we know, radically changed after the development of computers, and let's not even say computers, but PCs. Okay. And then the easeability of software and things like Java and HTML and the internet. And whether we're talking about Elliott waves, we're talking about Fibonacci numbers, we're even talking about trading with candlesticks, it was this single most important thing, and that was PCs and internet and Java and HTML software. Together, we got all types of charts that we were able to easily manipulate to drop these indicators on and to use them in our trading. Now, Elliot broke down the first thing that was important is what we call motive waves. There are 2 types of motive waves, an impulse and the diagonal. Okay. Now, an impulse wave is the kind that we've been using so far to illustrate how the structure of Elliott wave is put together. It's this push pattern, up, 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 up. Like all motive waves, it consists of 5 subwaves. 3 of them are also motive waves, and 2 are corrective waves. In other words, inside of this main wave, you have 5 subwaves, 3 pushing up and 2 that are correcting down. Or what do we call them in trend analysis? We can call them pushes and knees, higher highs and higher lows. But it's the market pushing up, easing back down, pushing up, easing back down, pushing up. So when you think about it, when we talk about the 3 motive waves, those are the pushes up. And the 2 corrective waves are the eases back down, the troughs and the valleys, the peaks and the mountains, whatever you want to call it for. And the 3 rules, there are 3 rules that apply to this. Wave 2 cannot retrace more than 100% of wave 1. Well, what do we get in trend analysis? We get a higher high, a higher low, a higher high, a higher low. Okay. The higher low can never be lower than the previous higher low. Okay, because what happens, it breaks the trend line and the trend line is broken. So wave 3 can never be shorter than waves 1, 3, and 5. And wave 4 can never overlap wave 1. So you can see it on my little chart here. These are the rules or the laws. Now, in the majority of cases, impulse waves will exhibit what is known as or called an extension. This means that one of the impulse waves, 3 motives, subwaves, will be elongated, an elongated impulse with exaggerated subdivisions. This can either be a 1, 3, or 5, and it typically happens in only one of these waves. Okay. Now, if we were looking at trend analysis and looking at the markets pushing up, higher high, lower high, higher. There's usually the third push is that mega push. What happens is the traders start coming in the market, they're pushing the price up, it's easing back down, pushing it back up. Okay, by the third push, they're really concentrating, pushing the market up. We can see this easy enough in Elliott waves. Now, a wave extension is not easily identified. If you run into difficulty seeing these extended waves, try your best to label the overall impulse and move on. And there are times when the market has become so overextended, a wave 3, that there is not much force left for the impulse wave to come to a proper completion. So we could get a truncated fifth wave. Now you see why I don't. It's not, again, they're not bad. There's not actually, like I said, my friends swear by them. I just don't have the time for all these little pieces. Okay. Now, a diagonal wave is a second type of motive wave. It is not an impulse wave. However, like all motive waves, its goal is to move the markets in the direction of the trend. Okay. The difference is that a diagonal looks like a wedge, either expanding or contracting. Also, the subwave of a diagonal may not count in the 5. The ending diagonal is a special type of wave that occurs in wave 5 of an impulse wave. So again, we go back to my basics of trend analysis and triangles, breakouts and support and resistance. Okay. This starts to get overly complicated with too many exceptions. Okay. Most ending diagonals have a wedge shape to them where they fit into two converging lines. However, they are cases where the wedge is expanding. What's a wedge? A wedge is basically a triangle with the two lines of the triangle coming into the apex of the triangle at different degrees. So hence, chart patterns. Leading diagonals are rare and found in either the wave 1 position of an impulse wave or the wave A position of a zigzag correction. And then we have corrective waves. When markets move against a trend of one bigger, higher degree, they do so in apparent struggle. This resistance prevents the pattern that forms from developing. So there are two types of corrective waves, a sharp correction and a sideways correction. And then you have zigzag corrections. You have flat corrections. And then you have expanded flat corrections. And then you have correction combinations. But remember, you're using Elliott waves to predict a long period of time because it's not, as opposed to Fibonacci, okay, or even a triangle. Elliott wave patterns don't cease. Once you start drawing them on your charts, they continue moving forward, and they continue all of this, giving you way into the future and covering all of your charts. It's not something you just add onto your charts. It's once you started, you keep adding these waves, these corrections, these waves, and interpreting the entire market. And you have double tops and triple tops in waves. There's all types of patterns you can look for. You have to get familiar with drawing the waves on your charts, then drawing the subwaves or reducing the time frame and seeing what the waves are trying to tell you. But waves you trade by rules, and they're very strict rules. Wave 3 can never be shorter, the shortest impulse wave. Wave 2 can never go beyond the start of wave 1, and wave 4 can never cross into the same price area as wave 1. Now, we also have guidelines. A guideline is not a hard and fast rule that can't be broken. It's a tendency sometimes that happens so often that it qualifies for a rule except for the times it doesn't work as expected. So we have guide one, which is a guideline of equality. We have guide two, which is the guideline of alternation. Guideline three, the guideline of alternation within a correction. Guideline four, the guideline of depth of a corrective wave. Guideline five, the guideline of channeling. Guideline six is the guideline of scale. And so on and so on and so on and so on. So if you're going to delve into Elliott waves, you have to become an expert. It's not something you can try out now and then. It's not something you can find a new asset and just start from this point forward, because they don't have any validity till you've identified the primary and the subwaves and the subwaves to understand exactly what you're looking at. Because remember, waves have personality, or the wave personality is the reflection of mass psychology acting in the market. The emotion that follows from optimism to pessimism, creating the structures we have in the market. The personality of each wave type is the same whether it is a higher degree wave or a lesser one. Please keep in mind the 8-wave cycle, 5 and 3, 5 and 3. Okay. Now, so far, there might be, but I have yet to see it, and like I said, I don't trade Elliott. So far, I haven't seen an automatic program that will discover them and drop them on your charts for you. Okay. So I don't know of an easier way to tell you how to draw these, except draw them, practice them, and then continue on, just like I do with my eyeballing support and resistance. It took a long time to get them on all the charts and the assets I trade. And like lately, it's been insane with the euro dollar dropping down to the, under the dollar, the euro pound, the pound to levels they've never traded at before, because now I have to find all these new lines because we're not anywhere near historical trading, where prices were historically. But once price moves back in some direction, my older lines will come into fruition. Elliott wave is you have to continually draw them on because there's no automatic way to bring them forward. It's a matter of work. But if you put in the work, you'll find that they do work and you'll be successful. So that's all today. It's just a general basic guideline to Elliott waves, so you've got a little bit of knowledge in your head. Okay, I can't do an advanced course on Elliott waves because I just don't know anymore. And that's about as honest as I can be with you. So thank you very much for joining us today, and good luck with all your trading.